a substantial part of my life, you invested in bonds, in debt instruments for yield, and you invested in equity instruments for growth. Now, very often, the equity instruments yield more than the bonds, and people are buying equity instruments for the yield, and they're buying bonds in the hope that the Fed lowers the interest rate again and they can enjoy some capital gains. The disposition of capital, if that's the right word, has been really, really seriously altered by these interest rates signals. Similarly, the Fed, I think, has deliberately caused investors and savers and voters to misunderstand two different words in English. One being liquidity, which we have lots of, and the other being solvency, which we have none of. And I think that investors increasingly are substituting in their own minds liquidity for solvency. And I don't think that has a happy ending. If I could illustrate, if one of your listeners made, I don't know, $60,000, $70,000, $80,000 a year, sort of, middle income, owned a house that had appreciated well over the last few years and did as many people did, borrowed against the house, and let's say now they have an $800,000 or $900,000 mortgage, which probably becomes unserviceable at their income level. But they have $10,000 in their pocket. They have $10,000 worth of liquidity. They can buy beer. They can take their family to Disneyland, but they're in some danger of becoming homeless. This person is liquid, but this person is not solvent. Mm-hmm. And the actions of the Fed have caused investors and savers around the world to confuse liquidity with solvency.